Good afternoon, everyone, and welcome to this Azvalor Managers presentation. On behalf of everyone, the partners, the employees, I'd like to first thank you for joining us this afternoon in the presentation of the Azvalor Managers Fund. The goal today is, on the one hand, to bring you up to date about the fund, a fund which is about to celebrate its fifth year. It's already over 70 billion euros in assets under management, and there's almost 1,100 co-investors that are part of it. And then the second goal is to tell you about one of the managers who have joined Azvalor Managers recently from 3G Capital. And to do that, we are going to start with Javier Sáenz de Cenzano, who is an Azvalor partner, and he is responsible for the Azvalor Managers Fund. Hello, are you ready for the presentation? Yes, and we also have Pavel Begun, who is the founding partner of 3C Capital Management and who is head of investments together with his partners, Vail. Pavel, good afternoon.
Here.
Okay, fantastic.
Thanks for having me.
It's our pleasure. La presentación la hemos...
The presentation is going to be divided into two sections. First, we'll hear from Javier. There will be a presentation to bring you up to date. The Azvalor Managers Fund will talk specifically about the two new managers that were recruited in the month of June, and then a second section in which Javier will be interviewing Pavel Begun so that we can get to know the history, the background, and the positioning of this unique management firm, which has truly special characteristics. Each of these sections will last for 20 minutes, and after each section, we will have a Q&A, so that when, Javier, you finish your presentation, we will answer questions coming in from investors. And then we'll start the interview with Pavel, and then when he's done, we will have a Q&A for that as well. The plan is to finish after about 60 minutes. If we receive questions from you, and you can use your devices, and in fact we've received some questions already, but in case we are not able to answer all of them, we will be contacting each of you to answer those questions. And so the first section, the first part, which is going to be led by Javier, will be in Spanish, and then the second part will be an interview in English. And in your devices, you can select the language, and you can access simultaneous translation into Spanish or listen to Pavel in English. And without any further ado, I want to thank you for joining us today in this event, and I'm going to give the floor to Javier Sáenz de Cenzano so he can start the presentation. Great. Thank you very much, Beltran. It's a real pleasure to greet you all. I'm going to be relatively brief so that we have plenty of time for questions. But getting to the point, just going over what's been happening with the fund in terms of return, as many of you will know. In the year, it's been about 12% from its founding just 5 years ago. It's at a cumulative 47%, which means an annualized return of about 8%. And the fund's goal is to generate double-digit returns. So we're actually below what we think the fund can do over time. But we think the best thing for the fund, the best time for the fund is still to come, and later we'll explain why we feel that way. And as for the fund, it has a 5-star rating from Morningstar recently. It's a Clearwire AA rating, and last year in 2022, it received the award to the best global active fund. And so, as Javier was saying, this is a consolidated fund over 5 years with around 70 million euros under management. Of course, the Azvalor partners and employees also invest in it, and overall, we are the top investor in the fund by volume. Moving on to the portfolio, as you know, in the fund, what we try and do is to compile some of the best ideas of those we think are the best managers globally. And so, as we've said, we are now joined by two new managers whom we'll talk about later. That's the biggest piece of news. But the profile of the portfolio overall has not changed too much over the last months or quarters. We have approximately 150 names. It's highly diversified geographically with strong presence in the US, but also in other markets. Also, significant sector diversification, significant weight of small companies, which represent about 70% of the portfolio, including medium-sized companies. The percentage would be 90%, and then there's a very small percentage of about 10% of corporates, which is not actually a predetermined target for the fund. But since our managers try and focus on slightly less well-known areas where it's easier to find extremely undervalued opportunities, it's almost the natural universe, that of small, very small-sized companies, in order to find those opportunities. And in the last months, as usual, we've had regular meetings with the managers in order to talk about the portfolio and with each of them. And in general, I would say that the performance of the different companies is moving in the right direction, with significant growth in profit and cash flows. In many cases, a lot of them had started out at a low point in their business cycle, and so this cash flow generation is enabling them to strengthen their financial position even more, to reduce debt in their balance sheet if they had any, to increase their payout, and to allocate capital intelligently by doing share buybacks, which at these prices, and we'll talk about the valuations in the fund, but at these prices, that creates a lot of value for shareholders, and it helps to improve trading prices. And so in general, we have companies that have strong capital ratios with low debt ratios, which can withstand difficult economic environments. And in the annual Azvalor conference last February, March, we spoke about the fact that it was very common to see companies in the Azvalor Managers portfolios that were being the object of buyouts by other companies or financial actors. And the last months, we've had up to 12 companies that have been acquired at prices that go from plus 30% to plus 270% versus our purchase price. And in fact, this has continued to happen in the portfolio, with 2 new companies being acquired in the second quarter of the year. And even though they didn't represent a lot of weight within the fund, they do validate the investment assumptions and their value, and are enabling us to rotate towards other opportunities. In both cases, they were acquired by competitors in the same sector, and we think it's highly probable that this will continue to happen given the profile of the companies that we select. And as we've said, we have 2 new managers in the fund. One of our managers has exited, Middleman Brothers, because they've closed their firm. And so I'm just going to review each of them briefly. First of all, we have Southern Sons, and they're not here, so I'm going to dwell on that a bit more. This was an asset management firm we got to know a couple of years ago in one of our trips to the US. In this period, we've analyzed their investment process. We've looked at all the relevant aspects that you need to look at when investing with a particular management firm. We've had 7 to 8 meetings with them until we reached the level of conviction we needed to include them in our fund. They were founded in Memphis in 1989, and it's employee-owned 100%. Since 2020, and that's interesting because employees acquired the stake that a well-known American company, AMG, had in Southern Sun. They acquired that back, and since then it's fully employee-owned, and it's led by 2 people, mostly. Michael Cook, who has about 35 years' experience in asset management, and his son, Philip Cook, who has about 20 years' experience. And around them, of course, there's 3 other managers who support them. And all 3 are extremely solid and experienced with diverse backgrounds, which means that the team is really very solid and very diverse. And as for the investment style, it's strongly focused on value, but always seeking companies that have growth potential, tested historical growth, but also expected growth potential. And that they achieve through a dominant position in their market niche. These are companies that, in many cases, have been around for decades and who have strong leadership in their niche market. Southern Sun's portfolio includes 20-30 names, mostly small and medium-sized American names. And that's a strategy which has been deployed very consistently for decades, beating indexes and peers very significantly. And just to give you a number, the return since 97, audited returns have been 1,913%, which is 12% annualized, which is also 3% over the index. And the difference is even greater with respect to some of their competing funds. But over such a long time period, that means they have generated over 1,000% more than the market during that period. And secondly, and here, of course, I'm not going to go into too much detail because we have Pavel to tell us all about it here. But just as an introduction, I will say that 3G Capital is an independent asset management boutique founded in 2004 by Pavel and his partner, Corey Bailey. They both have over 20 years experience and they worked together before founding 3G. It's a company that has small volume under management in terms of asset size. The portfolio is a global portfolio with 10-20 names with strong bias on emerging markets and from borders like Asia, Middle East, Eastern Europe, but also developed markets like currently the UK. And to represent 3G, and well, Pavel will be telling us about what they look at when they look at companies. They look for exceptional businesses, top-level executive teams, and extraordinarily low valuations. And the way they manage risk, that they invest in jurisdictions which may sometimes seem to be riskier, is by carrying out a very deep analysis of each company and being very strict with those three criteria I mentioned before, buying very solid companies at truly exceptional prices, which give you that extra margin. And to finish with 3G Capital, since the strategy became global at the beginning of 2009, their annual return has been just over 16%, which means beating the index by over 6% annual. And now I'm going to talk a bit more about where the fund is and where the valuations are and what we might expect from the fund over the next years, long term. First, where is the market? We've had a decade of unprecedented monetary policies, which has caused significant distortions in the markets at various levels. And in spite of the corrections in 2022, there's still part of the market that's very cheap and another part of the market which is very expensive. And in this graph on the slide, you can see the AQR graph, which we always like to monitor, which shows the divergence in valuations between those things that are cheap and those things that are expensive in the market. And you can see that the difference is still at a level we only saw when the technology bubble burst. We think that this divergence is not sustainable long term and that it will tend to converge. As I said, these distortions can be seen in different parts of the market, but this is a good example. This is a chart where you can see the return of the big American technology companies versus the small caps, American small caps, and you can see the trend in the markets in the last 20 years, and this behavior is what explains that difference in valuations I mentioned before between those large techs, growth companies as they're usually called, and the smaller, more value-oriented companies. And of course, the divergence between value and growth did decrease slightly in 2021 and 2022, not so much this year, and so it's still at record highs. And why is this so important? Because long term, the price that you pay when you invest is critical to the returns you will obtain in the future. When you pay a low price, and we can see this in the PER ratio on the slide, the return over the following decade tends to be rather high. On the contrary, when you pay a lot for your investments, the PE ratio is a lot lower, no matter how well the companies perform. And in some cases, you might not even be able to beat inflation in the next decade. And that's why we always say at Azvalor Managers that the price you pay is the most important thing. And of course, to understand each company in depth and to follow a solid, tested process so that you can minimize the number of investment errors. And in that sense, where are Azvalor Managers today? Well, or where is the fund today? In terms of returns, it's at under 6 times the PE ratio, which means it's at about a 70% discount, which is extraordinary. The free cash flow yield, based on the company's cash flow generation, is at around 17%. That is, if the markets close today with the current trading prices, in under 5 years, we would have recouped our whole investment in those companies, all the capital we put in, and we would continue to own the companies, which gives you an idea of how attractive these prices are. And that's why, and to finish, I said at the beginning that we feel that the best thing for the best time for this fund is yet to come. Of course, we can't really foretell the future. We don't know when the companies in our portfolio will reach their appropriate valuations, something that tends to happen suddenly. But we do know that investing in the right companies at extraordinarily low prices, selected by top-level managers through individual analysis of each name, is the best way to have a safety margin versus any future storms and to try and achieve those double-digit annual returns long-term, which is the goal of the fund. And I'll stop there, Beltran, and I'll be happy to answer any questions that might have come in. Well, great, Javier. We've actually used less than 20 minutes, so we've got plenty of time for questions, which we've received. And I'd like to remind those of you who are watching that if you want to send us questions, you can do so now, and we'll answer them in turn. First question, you spoke about the quality of the balance sheets of the companies and how solid these companies are. And this question is precisely about how the fund would react if there were a strong correction in the financial markets. Well, that's a good question, and I would answer it first in more general terms and more specifically about Azvalor Managers. And here I'd refer to an academic research published a few years ago, which was called God's Portfolio, where what they did was to study if you had a crystal ball, that is, if you could really know exactly what was going to happen with the markets and with the companies in the indexes over the following years, what return would you obtain and what would be the risk scenario? Yeah, optimizing the portfolio every 5 years, periodically knowing exactly which companies will perform best in the next 5 years. That return you would obtain, if you could tell the future, would be 30% annual for 90 years, which was the time span for the study. That would be the best manager of all times, obviously, and a total genius. But during that time, you would have had significant corrections relatively frequently. You would have had a maximum correction from peak to trough, and again, knowing how companies are going to perform, of 75%, and you would have had several corrections of 30, 40, 50%. And in fact, I think we have in the annexes a slide about this study where you can see those corrections in those 90 years. And here, what we are saying is that there are always going to be corrections in markets affecting funds. If you want to achieve good returns, the only alternative, or the best way to do it, is to forget about that volatility, which may happen at given points in time, and to remain invested long term. And it's true that sometimes investors are tempted to exit and enter the market at different times, and it's been proven that that is usually a recipe for disaster, because if you miss the best days, that has a negative impact. Returns sometimes appear suddenly, and so the only solution is to remain invested and to even take advantage of those corrections to increase a position if you can, even though emotionally, of course, you might not want to do that. But if you think about it and analyze it, you should take advantage of those corrections to capture opportunities. And moving on to my second answer as far as Azvalor Managers, what I would say is that our portfolio is very uncorrelated with the markets. The overlap with the indexes is practically zero. The active share of 99%, because these are companies that are under the radar. These are not companies that, most of them, even in the indexes, and that's why in 2022, for example, when the financial markets almost crashed various times, our portfolio, our fund, remained practically flat. And if you look at the background of the managers in the fund who were really active at the end of the 90s, beginning of the 2000s, when the technology bubble burst, which is somewhat similar to what's happening in the markets now. These are managers who, when there was a 30, 40, 50% correction in the markets in those days, achieved positive returns. I'm not saying that the same exact thing's going to happen necessarily, but we do think that the way to protect yourself over time from permanent capital losses, again, is to buy cheap and to buy the right companies. And in that sense, we think that with the fund being valued at about 5 times P with these managers, we are on the right place. And again, you can have corrections at certain points in time, but long term, we think we're really well positioned. And finally, to finish, I think we shouldn't pay that much attention to all the noise coming in from different media and different actors, and to keep calm so that you can withstand those storms and capture that long-term return. So it's the value of confidence, Javier. And by the way, I think it'd be correct to say that that study about God's portfolio is in Azvalor's website, if anyone's interested in reading about it in more detail. Okay, and the second question, investors asking if, in order to understand what you're explaining about Southern Sands and 3G Capital, the 2 new managers that have been included in Azvalor Managers since June, could you give us examples of some investments they've made? Perhaps you can discuss this with Pavel later, so maybe you should start now with Southern Sands, just to give them a practical example of a name. Yes, I think we're going to let Pavel go through their choices, since he can do that much better than I can. But for Southern Sands, we can say maybe that, well, first of all, explain that the investment process is focused on buying very solid companies with solid, consistent growth in the past and in their forecasts, and with very solid financial position, with the right executive team, and with an attractive valuation. And just to give you a few examples and some visibility, they have names like leading manufacturer of luxury malt beverages. They also have an operator of convenience stores near one of the biggest warehouses in the U.S., the biggest manufacturer in the world of motorhome. They also have a company that is one of the leading companies in agricultural equipment. And I could maybe explain their investment style by giving you a bit more detail about that. That's a company that's based in a small town in the US, but it has a really global business with a market cap of $9 billion. And again, it's the leading manufacturer, and the leading company in various businesses. First of all, agricultural machinery, like tractors. They're leading tractor distributor in Europe and Latin America, and especially in Brazil. Also, a leading company in grain storage. It's one of the biggest also in equipment for manufacturers of swine and avian feed. And they have very strong cash flows, which are enabling them to pay out dividends and do share buybacks. And it's a very solid company overall. And just to give you an idea of the valuation at which they're trading, they are at about 5.5 times EBITDA. And they had some debt in the balance sheet a few years ago, but through this strong cash flow generation, they will close the year 2023 with net cash, a net cash position, no debt. And finally, they have a very experienced management team, not just on the operational side, but also on the capital allocation side, which is going to be key for the future of the company with the recurrent cash flows they're generating. Great. Well, that was very clear. Thank you very much, Javier. And then there's a third question Understand that Azvalor Managers is an investment solution where you combine different asset management firms in a single vehicle, which is accessible for Spanish investors, but also European investors. That's clear. But is there some criteria, Javier, when selecting each asset manager and how they complement the other managers within the portfolio? Well, that's actually a difficult question to answer. I could spend hours answering that, but you have 3 minutes. All right, I'll take 2.5, and in order to try and understand how they complement each other, you have to understand their investment processes in depth, and so talk about a lot of the specific names they've invested in. It's not just about whether they're value investors or not. It's understanding exactly what their investment process is, and in that task, a critical factor is the help I get from Azvalor's investment managers who have managed for over 25 years, so they know the sectors and they know a lot of the names, and so they can go that last mile in the analysis and really check the consistency of the analysis of the person they're talking to, and perhaps challenge some things or see whether their analytical framework when doing an in-depth analysis of the companies is the right one. And of course, it's true that they all share a strong value focus that's critical, and they all focus on attractive valuations. But the way they apply it is also very different in terms of the type of companies they invest in, but also their areas of expertise, regional or by sector. And I'll explain it very briefly. For example, Donald Smith and Company, which is one of the asset management firms that has been in the fund from the beginning, and Southern Sons, they both invest in American companies, but their styles are very different. Smith and Company look for smaller companies and companies that are very cheap in terms of their price to book value, and from there they start doing their analysis. But Southern Sons, again, as I said, are more focused on solid growth companies, very robust companies with perhaps in general less cyclic businesses. And then we have Ameris Capital, which can invest on anything in any part of the world. They have total geographical and sector flexibility, also in terms of the size of company. And they have some exposure to Latin America these last years because that's where they found more opportunities. And then we have Ian and Rosenbach, who are specialists in companies that are in the natural resources area, and they've been managing those types of strategies for 30 years. And finally, we have 3G Capital, which, as I said before, is a more global portfolio, more concentrated with slight bias on emerging countries and frontiers. Well, complementary with each other, but we're also with Azvalor's international and blue chips portfolios. So there's some overlap, I guess, in the underlying names, but very little overlap in the names of this portfolio with respect to the other Azvalor funds. Yes, very little overlap. As I said, the overlap with the indexes is almost zero, and with very international, it's also very small. And from multiple perspectives, these are highly complementary portfolios. Great, we have 1 minute left, so I'm going to ask you the last question from Raul. It says, what is the fund's liquidity position right now? And also looking in the portfolio, what is the company's debt position? What is their debt position on average? And how would they react to a potential or effective or actual rising rate scenario like the one we're living in now? Well, starting with the first part of the question, as far as liquidity, it's true that in the last months or quarters, liquidity has been a bit higher. We were working to include these 2 new managers, and now, for that reason, it's gone down significantly, from about 8-9%, and it will continue to come down in the future. And as for the debt position of the companies, of course, you would have to look at them on a case-by-case basis in terms of their individual balance sheets. But overall, the companies have to be financially solid. That's intrinsic to the analysis process and our investment process. That's always been part of the DNA of our asset managers, to avoid investment errors by investing in companies that have strong capital ratios in order to avoid any permanent capital losses. And the other thing I would say is that That's part of their basic investment philosophy. But in fact, it's become even stronger in the last few years because of what I said earlier. Because through the excellent performance of these businesses, the companies have been able to reduce their debt levels, and so they're very well positioned to perhaps some of them who are not paying out dividends to start paying out dividends and doing share buybacks. And just to give you an interesting figure as far as the share buybacks, Don Smith, one of the managers of the fund, said that about 70 or just over 70% of the companies they have in their portfolio are doing share buybacks. 70%, yes, 70% are doing share buybacks, which is a level that had never been seen before in their career, 40 years career as managers. Well, great. That's the end of the first section, almost on time. We've been really strict with time. And now let's start the second part of the section, the interview with Pavel. Go ahead, Javier. Yeah, just one more comment. Practical comment before we start. We're going to switch to English now. And again, you can use the language tab on your device to select the language you wish to hear. There is simultaneous interpreting to Spanish, but you can also hear Pavel directly in English. It's at the bottom of your screens. There's a small tab where you can click and select the language you want to hear.
Thanks so much for being here.
Sure. Great to be here.
Welcome to Spain, welcome to Madrid, and welcome to Azvalor and Azvalor Managers.
Yeah, great to be here.
As we have a limited time, Pavel, I'm going to try to be as executive as possible. So I'll start with a probably more general question about your background. So you've been kind of an overachiever during your entire life. You started as an entrepreneur at a very young age. You moved to the US. You started your own investment company. So kind of the American dream in a way.
Right.
So maybe you can walk us through that period, how you kind of got interested in investments in the first place, and how you kind of saw or lived through all those years when you were kind of building up 3G Capital.
Yeah, sure. So basically, for as long as I remember myself, I always wanted to be a capitalist entrepreneur, despite growing up in what was back then a communist country. And when the Soviet Union split up, Belarus became independent. Basically, business opportunities sprang up, and I started, getting engaged in different ventures ever since I was like maybe 11 or 12. At first, I was selling strawberries at a local market. Then I started selling advertising space in local newspapers. Then I started selling rebars to reinforced concrete manufacturers, and finally, I started an accounting magazine. So all of those businesses were interesting. However, they were not really scalable. And I was looking for something different to where I could sort of make it global and basically something where I could learn something new every day. And for that, I felt I needed to come to the U.S. So I applied for and won a scholarship sponsored by the U.S. government, awarded to the best students in Belarus. So made it across the pond, ended up at Western Kentucky University. And this is where I sort of got exposed to value investing through learning about Buffett. I basically was sort of searching for a business that I could be engaged in for the rest of my life. And as I was going through the list of the richest people in the U.S., it's sort of like what Buffett said resonated with me. Seemed like that was a good fit for my personality. And I started exploring value investing. So I thought, that'd be a fit. And made a lot of sense to me, so I put together a small portfolio based on value investment principles, and later on that was the foundation upon which 3G Capital was built, and that was in the late 90s. That was actually at the height of the dot-com boom, and I think I was the only teenager buying old economy stocks at 4 times earnings. All of my peers, and actually even people much older than me, they were buying like all those new age companies, high tech, or making money but selling 30, 40, 50 times earnings, or maybe not making any money at all. And at first I was losing money versus the market. I think the first year I was down maybe 15 or 20%. The market was up in the double digits. I looked a little dumb despite doing the right thing from the get-go. However, within a 3, 4, 5 year time span, I've done way better than the market. which, again, the sort of the lesson is that, when it comes to investing, that 1 year doesn't really matter. You have to focus on the 3 to 5 year time period, because that's really going to tell you the story.
So you had this kind of inoculation of value investing, as Buffett puts it, that's either takes you in the first place or will not take you ever.
Exactly. It's either right away or never.
Maybe you can discuss a little bit how you met your partner, Corey, and how you kind of work in a kind of day-to-day basis with him in terms of the workload, in terms of going after companies and doing research, etc.
Yeah, sure. So basically, how we met, we both worked at a traditional money management firm based in St. Louis, Missouri. They ended up putting us in the same office, and basically we started talking about investing. And what we realized that our passion was running money in a slightly different way versus the majority of the value, or of the traditional, I should say, money management industry, because on average, the average money manager is sort of in the asset gathering mode, and we wanted to start a firm that be more focused on producing returns as opposed to asset gathering. We thought there was a space to do it. This was something we were passionate about. So we basically ended up going out on our own. And, we went to our boss to inform him, and, ironically, even though I didn't think someone who is sort of working in the traditional money management industry would be willing to trust somebody who wants to do value, he became our first client. So he actually wrote us a check. He's a happy client. He's been with us since day one, made good money. So he's not unhappy.
Yeah.
So that was 2004. So that's when 3G opened doors. And in terms of the process, I think when you think of how our research process is set up, you have to think about airplane safety. So if you look at the improvements in airplane safety over the years, the reason that it's so safe to fly today is because you have redundancy built into the system. So every system has a backup system, and even the backup system a lot of times has a backup system. And so that's how Corey and I structured our research process. So what we basically do is run our processes independently as to make sure that there is redundancy when it comes to investment discovery. So if I were to find an investment idea that I thought looks interesting, I'm not going to tell Corey anything about it, because I don't want him to be influenced by my thinking. What I'm going to do, I'm going to basically go through the entire research process from letter A to letter Z, talk to my own sources, et cetera, et cetera. And if at the end of the process I come up with a buy recommendation, I'm going to talk to Corey about it. I'm going to tell him, look, here's a company, I think we should buy it. Well, then what he would do, he would go through his own process of research from A to Z, using his own sources completely independently of my work. And then at the end, we're going to compare notes, and we're going to see if we end up on the same page. And to the extent that we do end up on the same page, we make a buy decision. If we don't end up on the same page, well, then we try to see where the disconnect is. Maybe, we're dealing with different data sets, or maybe we slightly differ in the analysis or whatnot, and then, we see if we can come to the consensus. But, it's always data-driven. So it's not a gut feel. It's sort of like, we line up the data, and, to the extent that the data are right, well, then you're going to be making a certain decision.
Okay. And in the early days of your firm, you were focused mostly on U.S. names. You decided to change that in around 2009. I'd like to ask a couple of questions there, like why you decided to do so, and when you invest in more, apparently more risky countries, emerging markets, frontier markets, how do you kind of assess risks, like regulatory risks, political risks, currency risk? How do you go about that when you are dealing with these kind of countries, like, I don't know, China, some countries in LATAM, Middle East, etc.?
Okay, sure. And just to take a step back before I answer, I don't think I met any people in those emerging markets or frontier markets that ever thought of themselves as being in emerging or frontier markets. Yeah. So to them, those markets look perfectly safe, but markets outside of their markets is what they consider emerging and frontier. So
that's a fair statement.
Yeah. So Look, when we started off in the U.S., we saw a decent amount of opportunities in the U.S. And over time, we just realized that the U.S. market has gotten picked over. So the number of investment opportunities really dried up. So basically, we either had to accept a less attractive, price to value combination, or we had to go outside of our sort of usual pool of investments, which basically made us start looking internationally. Basically, we concluded that the probability of us, just statistically speaking, being able to find a high-quality business at a lower price is going to be so much higher if we enlarge the universe going from basically one country, which is the U.S., to the entire world. And besides that, what we also discovered is that the U.S. market is a lot more competitive in terms of like talent looking for ideas. If you go into those emerging markets, frontier markets, those markets are a lot less competitive. There's a lot less in a way of sophisticated long-term investors in those markets. So I think it's going to be easier to find those businesses that offer very attractive gaps between price and value. So that was sort of our initial thought process. And then in terms of managing risk, I think, we have to, take a step back and realize that investing is always risky. And you can do it in the U.S., you can do it in China, you can do it, in Spain, Italy, it doesn't matter. There's always going to be risk. Now, of course, our job is not to avoid it because unavoidable. You have to manage it. So how we do it, we basically study those markets very closely using sort of on-the-ground intelligence gathering networks in order to minimize the risks of investing. And then the second step, once you reduce a certain spectrum of risks, then what you try to do, you try to make sure that you get paid properly and adequately for the risks that you take. And then you also construct your portfolio in such a manner that any single risk that basically does occur does not bring down the entire portfolio and does not result in a permanent capital loss. So, and with that, there are different things. Just to get specific, there's, for example, confiscation risk. Like what happens if, assets get expropriated because like in some of those markets, property rights are going to be not as solid as they are, let's say, in the U.S. So, you have to be aware of certain things. For example, if you're dealing with strategic industries in certain countries, you have to be careful because if you're dealing with a private company in a strategic industry in those certain countries, you might have a big target on your back. So the government might eventually want it back, and you might suffer as a minority shareholder. So if you're looking at those businesses in strategic industries, perhaps you want to invest in a company that's aligned with the state or maybe state-owned or has a large ownership stake. So this way you're going to be protected. When it comes to political risk, again, you have to study management and who is behind what business, and you want to be sure that they don't have this propensity to get involved in politics. Again, if they have a propensity to get involved in politics in some of those countries, that could have dire consequences for the minority shareholders. And I've seen some cases in Russia and in Turkey, so that's another thing that we sort of just use to make sure you're not putting yourself at risk. Again, there's always some risk, but at least you try to minimize it.
Mm-hmm. And I'm thinking about your 3G approach, like good business, good management, and good price, or good valuation. Maybe touching on the valuation part of the equation, if you can explain a little bit what do you consider to be cheap, or what valuations are you prepared to pay, and how do you kind of approach your valuation methodology?
Right. So again, just to step back, because I know, in this day and age, there are tons of people, including like value people, saying, well, paying 30 times for an asset, could be a great price. I don't quite agree with that necessarily. If you look at the past, 50 years of history, 70 years of history, what you're going to see is that on average, the market traded at probably 15, 16 times. So, if you're paying double that, you're probably putting yourself in the line of fire, so to speak. So in our playbook, a safe price to pay would be anywhere between 4 and 11 times normalized sustainable earnings. And I'd like to emphasize that we're talking about normalized earnings rather than current earnings. And what it means is that anytime we look at a business, we try to normalize the earnings to imply the economic situation that's not too bad and not too good. So, and then we'd like to pay a multiple of between 4 and 11 times based on that. And of course, you know, for businesses that are growing faster, we're happy to go up the sort of the multiple scale. For slow growing businesses, would like a lower multiple, but you know, we normally end up in the 4 to 11 times range. And as a practical matter, if you were to look at our portfolio today, you would see that the price earnings ratio for the portfolio is less than 5 times earnings. And you see that the dividend yield is almost 8.5%. And now, of course, a lot of our holdings have excess cash and no debt. So if you were net out the cash, then your price earnings ratio would even be lower than the, I guess, 5 times earnings that I just quoted.
Mm-hmm. There was a question earlier about whether you could give an example of a company you know, that would represent well how you kind of approach investments, how you manage those risks we mentioned, and how do you go about defining what a good business is?
Sure. So I don't want to name any names.
That's fine.
But you know, there's a company in a certain country, and they're in the ERP business. And basically, couple of things. Number one, once you're number one in the ERP business, it doesn't matter if it's Brazil, could be China, could be Romania, or could be Argentina or the US, you tend to stay in the lead forever. People just don't switch. So this specific company is number one in the ERP business. And I think in terms of competitive sustainability, it's very solid. However, in addition to that, what you see is that they generate return on capital that are very, very high, 35, 40%. They have a good growth rate. Importantly, when we're talking about the risks in those EMs and frontier markets, I think a lot of times people bring up FX risk, right? So that company is well insulated from that specific risk because some of the product that they sell is export, euro denominated, and the other part of the product is local, yet that market is global, and all the competition in that company, they price their product effectively in euros. So they're really not subject to currency risk. And of course, it's not just theoretical. If you look at their growth in revenues and profits in the past 20 years, they've compounded in dollars at a 15% clip. So, you know, that company has no debt. They have cash, which is like 10% of the market cap. And it's selling at a very attractive price of like 6.5 times earnings. Now, you look at any other company, you know, be it, you know, frontier, developed, emerging market, I don't think I've ever seen an ERP company selling for less than 15 to 20 times earnings. So basically, you're selling for 1/3 of that. And historically, the company was sold for well over 15 times earnings. So, you know, management team is good operationally. If you look at the KPIs for the business, they're consistent with the peers, if not better. They do the right things with the capital. You know, they pay a dividend, buy back stock, and it's cheap. So that'd be one example.
Mm-hmm. And you know, in a market environment where, as I was referring to earlier, like where we have these extremes between cheap companies and expensive companies, and some, you know, very well-known investors like Seth Klarman calling it the everything bubble. So everything seems to be expensive in the market in one way. So how are you able to find these kind of companies that are very solid and that are so cheap?
Well, and I guess this is to say that, you know, like it's not really the everything bubble. Like tons of things are expensive.
It's obviously a generalization.
Right. But I'd say, you know, number one, our investment universe is very broad. So we have the flexibility to go into certain neighborhoods where other people perhaps are going to be a little less willing to go to. So that's number one. Number two, we have expertise that we develop in the course of being in the markets for 2 decades, and that enables us to find those unique names and unique niches that most people are really not really looking at. As a result, we can actually find those names that combine high quality with very low prices.
Okay. I'm going to ask a question that came from the audience, so I'm going to read it just to make sure I get it right. So it says, inflation seems to be here to stay, with some data points on the interest rates curve suggesting we will have more inflation than expected and for longer. So do you see similarities with the US situation in the 70s that ended up with Volcker's intervention in 1979, raising rates to 17% and bringing the economy to a halt in order to control inflation? And how would you protect your portfolio from this kind of inflation risk?
Right. So a few things. Number one, when you talk about inflation, you're talking about the developed markets. It's not an issue everywhere. If you look at China, they're actually dealing with deflation, not inflation. And to the extent that we're globally diversified, maybe inflation is not an issue in all the markets that we'll look at.
Yeah.
But of course, something that we have to take into account when investing. And like we've dealt with that issue before in places such as Turkey, for example, or Brazil, like where they have a history of very high inflation. And the way you protect against that inflation is you have to identify those specific businesses where they can easily pass any negative impact of inflation onto the end user. So this way they're going to protect their margins and maintain that profitability. And what kind of businesses would those be? I don't know, could be confectionery, could be beverages, so that sort of stuff. Now, if you're looking at maybe like utilities, that's going to be tougher because I don't think it's going to be easy for a utility to just basically make an automatic pass-through of inflation onto the end users. But at the end of the day, key is finding those businesses that can actually increase prices in line with inflation or maybe more without losing volume.
Okay. I got a couple of more, let's say, personal questions coming from the audience as well. I think Ignacio is asking several questions, but one that we probably didn't answer yet is whether you have skin in the game. I mean, whether you invest your own capital in your strategy. And the other one is if you can tell us something about yourself, like what do you like to do when you are not doing research on companies and money in the portfolio?
Okay, sure. So in terms of skin in the game, definitely I do. Like over 80% of my personal net worth is tied up in the fund. So to the extent that the fund doesn't do well, I probably take much more of a negative impact than anyone who's invested alongside myself. And in terms of things that I like to do on my free time, actually like do different sports. I play tennis, but even though I'm trying hard, I'm still not as good as Javier. Maybe someday. So
we played a few months ago, but
yeah, I play soccer and hockey and stuff like that. So
okay, I think we got one.
We've got a question from an investor. Says, Pavel, isn't it excessive to have a concentration of just 10 to 20 business portfolio, even more considering that you're investing in the risky emerging or frontier markets?
Well, I think if I could find enough names that fit the 3G criteria, I'd be happy to be in 50 names. But the problem is, if I were to say I need 50 names, given how stringent we are and how disciplined we are with respect to each criteria, I mean, we're lucky to find maybe 1 or 2 ideas a year. So for us, to put together a portfolio of 50 stocks, I mean, that would just take a few decades. So.
There's another question for both of you, and it says, Pavel, you visited Madrid in 2017.
Yes.
What has changed in 3 years since then, and why, and this is a question that I guess is for both of you, why have you chosen to partner with Azvalor to the detriment of other investment firms in Spain?
You want to go first?
Well, what has changed in 3G since 2017?
Right.
Well, of course, our portfolio makeup is different, right? Because, certain names that were in a portfolio back then, they're not in the portfolio now. But if I were to look at the biggest change, I would say that if you were to look at our discount to value, 2017 versus today, our discount to value today is going to be much, much larger. sort of like, I think our historic discount to value was about 50%. If you were to look at the discount to value today, you're probably talking 65% or so. And I think the second question was why Azvalor?
Yeah.
Well, I think, they were interested in us and we're interested in them. So it's kind of like marriage. Like, I don't know.
Yeah.
How does it happen?
Yeah, I think, from Azvalor's standpoint, we've been basically doing research on Pavel for a few years now. Actually, I think Alvaro and Fernando, our co-CIOs, met Pavel probably 15 years ago, but we took our time to delve deep into the investment process. In the last, 4 or 5 years since we met for the first time, I think in New York, we've probably gone through 500-600 managers that we've analyzed to some extent or another. But rather than focusing on the track record, which we know that there are many managers out there with outstanding track records, to us, the most important thing is that the process to achieve those returns is the right one in terms of having the right long-term mindset, in terms of having deep research on companies in order to avoid permanent loss of capital, and in order to know as much as you can about a given company. And I think 3G Capital's approach in terms of being long-term, in terms of being contrarian, in terms of being flexible enough to go to areas where other people wouldn't dare to go for many reasons, many of which are related to the ecosystem of their firms. So this kind of flexibility, and also being a small firm in terms of AUM, that gives you flexibility to go to companies that others, even if they want to go, they can't go because they're too big. So to us, it's kind of a perfect combination of having the right people with the right ecosystem and the right process.
Muy bien, pues si no tienes más preguntas, Javier.
Great. If you have no other questions, Javier, that concludes our presentation. Thank you so much, Pavel.
Ustedes por la
Thank you very much, everyone, for following this Azvalor Managers presentation. Thank you.